Texas Instruments has long been a top choice for dividend investors. A juicy yield of 2.5% coupled with an impressive dividend growth makes it a very appealing investment for people seeking a passive cash flow. However, the currently high capex rates do hurt the cash flow, and the general semiconductor industry is currently in a down cycle. But despite these challenges, I found that TI still has an ace up its sleeve that no one, not even the analysts, seem to be talking about. So, is an investment in TI still worth it, or should you rather stay away? Well, in today's video I'll break it down. I'll look at the business models and the markets of TI, analyze their position by doing a Porter's 5 forces analysis, and look at the latest financial statements. I'll also check their valuation and do a discounted cash flow calculation to determine their fair value. And of course, I will also share the secret advantage that actually is a cornerstone of my investment thesis in the company. So sit back, relax, and let's explore TI's investment potential together. My name is Florian, welcome to Cashflow Maniac. Texas Instruments has the ticker symbol of TXN and they are listed on the Nasdaq. They're working in the semiconductor sector and were founded in 1930. At the moment, they have around 34,000 employees and their headquarters sits in Dallas, Texas. The market cap sits around $180 billion at the moment. Texas Instruments is a semiconductor manufacturer that produces mostly analog and embedded chips that are sold to electronics designers and manufacturers in many different industries and all over the world. The company has a huge portfolio of around 80,000 products that are integral to many types of electronic equipment, in contrast to high-end chips or leading-edge chips, like the ones that Nvidia designs, for example. The chips that Texas Instruments produces are so-called lagging-edge or trailing-edge chips. And these chips, while maybe not as exciting as high-end chips, are essential, especially for applications like automotive, industrial and medical monitoring equipment. Actually, many computing devices use not just one, but several of such chips for different jobs. And because these chips are often produced with older and established production techniques and don't rely on the latest technology, the lifetime is much longer and the same chips are often needed and used for the same products for many years. Also, the production yield is higher while the investment in production machines is lower, which often results in a more profitable business compared to high-end chips. Analog chips make up the vast majority of TI's business, with 74% of their revenue in 2023 generated in this segment. They are even the market leader in this segment. And these analog chips are used to power devices or manage power requirements like switches, different kinds of regulators and amplifiers. But it also includes sensors to convert analog real-world signals like sound, temperature or pressure to digital signals. Their second biggest segment, the embedded segment, generates around 90% of their revenue and includes products designed to handle specific tasks and include processing chips like microcontrollers, signal processors, or even application processors. Many of these chips are custom designs and are used in combination with customer software that is specifically designed to run on these chips. The rest of their revenue is generated with other products like calculators and certain custom chips like custom designed ASICs. Many customers of TI are working either in the industrial or the automotive sector, and these two sectors combined make up almost 75% of their revenue. This includes applications like factory automation, medical, aerospace and defense, motors, power deliveries, but also infotainment clusters, safety equipment, and body electronics and lighting in the automotive sector. TI is a global company with business all over the world, but around 33% of their revenue is generated in the US, 20% in China, and around 26% in Europe, Middle East and Africa. The rest is split between Japan 10%, rest of Asia 10%, and the rest of the world with only 2%. The analog semiconductor market is a growing market with an expected CAGR of around 7% overall until 2028. Some segments like automotive, industrial equipment and consumer electronics are expected to grow with double digits even. And as we just saw, these are exactly the main markets that TI's products are used in. So I believe that there is a good chance that Texas Instruments can grow even quicker than this overall market. Unfortunately, the semiconductor market is a cyclical one with up and downturns, and at the moment we are experiencing a downturn. We can see this in the number of units shipped by Texas Instruments as well as in the financials that we'll check in detail in just a minute. What is important to see with cyclical companies is that the next upturn always ends up being higher than the last one. So we'll have to check if this is also the case with TI. I closely follow the super investor Terry Smith because his long-term investment strategy puts a huge focus on resilient and essential businesses with high margins and good cash flows. These are all metrics that also tick my boxes. And Terry Smith seems to find the market and TI especially interesting, as he just bought more than 1 million shares of the company in the last quarter. And for me, that alone is a good reason to have a closer look at TI. So before we take a detailed look at the financials, let's first check the strategic position to see if we can find out what Terry Smith likes about Texas Instruments. And first of all, I would estimate the threat of new entrants as low. The semiconductor industry, especially when producing their own chips, has very high capex requirements, as we can also see with TI right now. This, combined with the required expertise, makes it very challenging for new players to enter this market. The threat of substitutes I would estimate as medium. TI's products are quite complex and sometimes even custom built or highly integrated. This makes it very hard for their customers to switch to other suppliers. But they still have to follow the industry guidelines and standards though, and the rapid evolving semiconductor industry brings constant risks that alternative technologies may be better. So Texas Instruments has to always be on their toes to stay relevant. The competitive rivalry is high. The semiconductor market is highly competitive with several global players. This increases the price pressure on all players, and companies must continually invest in research and also their production techniques to stay relevant. The relationship and long-term contracts with their suppliers helps TI, and with their huge product portfolio, they can act as a kind of one-stop shop for their customers. The bargaining power of their customers I would estimate as medium. As a provider of lagging edge and standardized chips, TI's products are mostly commodities and are sold in high volumes. This gives their customers some power, as the switching costs for such products is not as high as for leading edge chips like Nvidia's products, for example. There is also significant competition in this field, making it even harder for Texas Instruments. But the critical nature of many of their products, combined with a good reputation and huge product portfolio, helps to mitigate the power of their suppliers though. The bargaining power of their suppliers I would also estimate as medium. The semiconductor production requires special materials that are only available from a limited number of suppliers, giving these suppliers quite some bargaining power and makes it harder for TI to switch suppliers. But the size and volume that Texas Instruments purchases still gives them a decent position, and the focus on long-term relationship with their suppliers also helps in this regard. So overall, the position of Texas Instruments in this highly competitive market doesn't seem to be particularly strong, especially when considering their focus on lagging edge technology. Their huge portfolio size that is diversified over several industries and their long relationships with customers as well as suppliers still help them to stay relevant. They also have a great track record when it comes to scaling up formerly expensive and exclusive technologies, making them affordable for many players. But there is always the very real risk of disruption, and it seems that some of their competitors could adjust a bit better to recent developments in the market than TI did. If you do like the video so far, please smash the like button and consider subscribing to the channel in order not to miss my next video. The one-year performance of TI, while not quite as good as the S&P 500, with a total return of 70% in 1 year, is still very good and quite a bit the average return of the S&P 500. On a 5-year basis, the performance was basically the same, and on a 10-year time frame, the company could easily outperform the S&P with 440% return. Currently, the stock is trading close to all-time highs, which is a bit surprising when we check the fundamentals of the company. Here, we can unfortunately see a clear weakness over the last year in basically all metrics. Total revenue as well as net income, operating and free cash flow did come down a little bit compared to the numbers from 2022, and also the margins, operating margin, net margin and return of invested capital, while still quite high, did come down a little bit from the levels in 2022. I mentioned before that with a cyclical company, we should always look out for companies that can surpass the last highs in the next upcycle. And here with TI, we can see the cyclical nature of the company very clearly, as all these metrics are fluctuating around a bit. But we can also see that there is a steady uptrend, especially when we look at the net income and the free cash flow. We see that every new upturn is higher than the last one. Unfortunately, we also see that especially the free cash flow in the last year did decline much quicker compared to the operating cash flow. And we will see why this is in just a second when we have a look at the last quarterly update. But first, let's also check the balance sheet. And here we see again the same trend with the EBITDA, which is uptrending very nicely. We see again the dip in free cash flow, but we can also see that the company still has around $3 billion in cash. We also see that the company has a long-term debt to EBITDA ratio of around 1.3 times, which is also very nice to see, even though the liabilities did go up a bit recently. Texas Instruments is known to buy back shares, and we can see a very steady downtrend in shares outstanding. And actually over the last 5 years, they did buy back 0.7% of their shares every year. When we look at the latest earnings numbers from the first quarter of 2024 and compare it to the first quarter of 2023, we unfortunately see that the downtrend that we just saw is still continuing. And here all metrics have gone down compared to the year before, except capital expenditures. And while the cash flow from operations did also decrease a bit, the capex costs did increase by almost double compared to the year before. And of course, this has a great effect on the free cash flow. So what is TI currently spending so much money on? The company is putting huge amounts of money in new 300mm wafer fabs at the moment, with 2 of these 300mm production lines currently ramping up and 2 more are currently under construction. Most of the production for these analog semiconductors is currently still done on 200mm wafers. Compared to these smaller wafers, 300nm wafers have 2 main advantages. They can first of all increase the production capacity while at the same time lowering the costs. Texas Instruments expects a decrease in chip costs of around 40%, which results in an overall production cost decrease of around 20%. The timing for these investments is also good because the company can probably benefit quite a bit from government money that is spent on the Chip and Science Act. At the moment, the full amount of the benefits they will receive is not clear, but they expect around $4 billion of cash benefits until 2026, and after that, even quite a bit of tax credits. So there is definitely potential to ease the pain of these capex costs a little bit. The forecast for 2024 reflects the results from the first quarter. Here we see an expected dip in revenue of over 10% and an EPS dip of almost 30%. This is also reflected in the analyst expectations that show an average downside of around 9% with a maximum downside of over 40% and only a limited upside of 13%. These numbers are all with a 1-year price target. But over the next years, the business is expected to grow again with an EPS growth CAGR of 25% from 2024 till 2027 and a revenue growth of almost 15% annually. Before we come to the valuation, I promised you some very interesting bonus info in the beginning on a development that I think is overlooked and not many people are talking about. And this is the step from silicon to gallium nitride for power supplies. Compared to silicon, these gallium nitrides or GaN power supplies can deliver a greater power density, better energy efficiency, higher switching frequencies, as well as having smaller sizes. This performance and efficiency increase is essential for many fast-growing applications like data centers, solar panels, and even EVs. And although TI doesn't disclose the size and growth of their GaN business in detail, it has been hinted at that they are the leader in this special segment. They are currently also transitioning this production to their 300mm production. In the past, these GaN chips were quite sophisticated and expensive, so this move will actually enable the company to provide them in larger volumes at lower prices. And this scale-up of expensive technologies and making them affordable for a broader customer base is exactly the area where the company did excel in the past. And even though this industry overall is still quite small, I think that this can become a very interesting and quickly growing segment for TI, and it could play a very crucial role in the future. But right now, of course, this is still a bit of speculation, but one of the reasons I do like TE quite a bit. I'll also put you a link to a white paper about GaN power supplies in the description, so you can dig a bit deeper if you want. The valuation in all multiples, EV to EBITDA, PE and price to cash flow, are close to the highest levels of the last 10 years, even though the fundamentals are down quite a bit. With such a cyclical stock, it is dangerous to rely only on multiples because the fundamentals tend to have a quicker short-term changes in up and down cycles that will screw with the multiples. So let's also look at the current dividend yield, which is around the average level of the last 5 and even 10 years and sits at roughly 2.6% right now. The average dividend growth during the last 5 years is still close to 12%, which is great, but in the growth history, we can also see that this came down quite a bit in the last 2 years. And with the high capex that the company is paying right now, I would expect that dividends will also grow at a lower pace over the next few years. When we compare Texas Instruments to their peers, and I choose Analog Devices, Broadcom, Monolithic Power, NXP Semiconductors, and Infineon Technologies here, we see that on a 1-year basis and on a 5-year basis, the performance of TE in orange was quite low. And on a 10-year basis, while it was not bad, it is still overshadowed by Broadcom and Monolithic Powers. The valuation, PE, and price to free cash flow are not cheap, but much lower than competitors. EV to EBITDA is right in the middle of the bunch. From a growth perspective, we see that we have a lower growth in the top and the bottom line, but the profitability and the margins of Texas Instruments are very high. But before we sum this up, let's also have a look at the fair value calculation for the company. And here, for my discounted cash flow model, I used a free cash flow growth rate of only 7%, which is quite conservative. And as price to free cash flow multiple, I used the 5-year average, which sits at 21. For the multiples calculation, I used a net income growth rate of around 10%, which is in line of the 10-year average, and a PE multiple of 24, which is the 5-year average. For the Gordon growth model, I used a very low dividend growth rate of only 8%, because as we just saw, the dividend growth, even though it has historically been higher, in the last 2 years it was around 8 to 7%, and I don't think that it will be significantly higher over the next couple of years while the capex costs are very high. And with this assumption, first of all, we see that the discounted cash flow model only gives up very low fair values, mostly because of this very low free cash flow growth rate combined with the low value of free cash flow that we saw in the last year. For the multiples calculation, we come to a value of around 176, and with including the margin of safety of 20%, we come to a 141. And only the Gordon growth model, which takes into account the dividend payments and the dividend growth, gives values of 280 and with a margin of safety 224 US dollars. In this case, I would take the discounted cash flow model with a grain of salt, because I would expect that the free cash flow and the free cash flow growth rate will recover after 2026, even when disregarding the discounted cash flow model. The current valuation does seem a bit high compared to the fair value. So, is Texas Instruments a good investment now? I do like the business model and the markets that the company is active in, and I especially like the high margins combined with the past success to make expensive technology ready for mass production. And even though these manufacturers of analog semiconductors have been left out in the rain a bit in the current semiconductor down cycle and have not yet benefited from the AI boom, I do believe that this will change again over the next years, and with their leading position in GaN power supplies, Texas Instruments has a great position to benefit from this. And while I do believe that the high capex spending will hurt the stock in the short run, I still think that the company can benefit in the long run from lower production costs and even higher margins. I would not be in a hurry to purchase the stock though, as the current valuation in combination with the weaker fundamentals seem a bit high right now. The fundamentals are also only expected to recover by the end of 2024 or even next year. But for long-term investors, especially the ones with a focus on a dividend strategy, I believe that Texas Instruments can be a good investment over the next decade. And as full disclosure, I am already invested in TI, so my view might be a bit biased here. So please, before investing, do your own research and only use this video as a starting point for your own analysis. And guys, as we just saw, Broadcom had actually the best performance in this industry over the last couple of years. Next week, I will do a detailed analysis on Broadcom, and as soon as the video is up, I'll put a link to it right here so you can check it out. And if you don't want to miss out on my next videos, please feel free to subscribe to the channel and smash the like button to help the YouTube algorithm. That being said, thank you so much for watching, guys, and see you next week.